Good morning, everyone. Thank you for joining us today for our chat on meeting the challenges of ASC 842 and staying in compliance. My name is Naila Issa, and I'm on the marketing team here at Armanino. I'd like to go through a couple of housekeeping items before we get started. You can maximize or minimize the webinar pane during the presentation by using the red orange arrow buttons in the upper left corner. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type your question in and click submit. Our presenters will answer those questions as time permits or at the end of the session. Second, for good audio quality, please check your setting to ensure the appropriate audio option is selected. If you're using a telephone, please click on the phone call audio option. Or if you're listening through your computer, please click on the computer audio option. As a participant, you will receive a link to the presentation and recording within 48 hours. To qualify for CPE, you must use a personal computer and log in with your own information and unique URL. You must be logged into the GoToWebinar platform for at least 50 consecutive minutes within the scheduled timeframe of the webinar. You must actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. We have a great group of panelists with us today from Armanino. They are Teresa Brown, Partner Consulting, Tom Brunton, Managing Director Consulting, and Grant Lamb, Audit Partner. Now I'll pass it off to Teresa, who will get us started.
Thanks, Naila, and welcome everybody to our discussion today. I'm really excited to be I'm not the expert, I'm the moderator today, so I'm really enjoying that role. We're going to spend some time really understanding how to plan, manage, and implement all of the changes that are required to become compliant. We'll go pretty deep into that. Help you understand where your organization falls in terms of what the new standards are. Develop an understanding of the rules and how that's going to impact not only just your accounting, but your forecasting, your policies and procedures, any KPIs and financial reporting and budgeting. And then finally, scattered throughout the presentation, we're going to listen to what the auditors and our consultants are hearing about the adoption and what they're seeing as we're actually out there working at client sites. So I think to kick us off, it's really nice to level set and get a base understanding of what is ASC 842. So I would like to turn this over to Grant Lamb, who is going to give us some basics, and we're going to start there.
Thanks, Teresa. Hey, everyone. Thank you so much for joining our webinar. Again, my name is Grant Lamb. I'm audit partner here at Armanino. So just before we dive into the discussions, as Teresa mentioned, we thought it would be really helpful just to spend a few minutes providing a very high-level overview of the new lease standard and talk through the impact it will have for both lessees and lessors. Again, the next few slides are only meant to be a very high-level overview. I performed the annual training of 842 for our audit department, and it's a 4-hour session, and we go the entire 4 hours. So a lot of content to cover. And we obviously won't get through it in these next couple slides. So this new standard is going to change the accounting for both lessees and lessors, but it has a much greater impact for lessees. The most significant change for lessees is that the future minimum lease payments from your operating lease will now be on the balance sheet as a lease liability, which is a pretty big change from the current standards in which only capital leases made it onto the balance sheet, right? Under the current standard, operating leases were only buried in the footnotes as a disclosure item. Also want to point out that the new standard retains a concept of an operating lease versus a finance lease. There's just a slight change in the terminology. We now refer to capital leases as finance leases. And the only exception to not having to put leases on your balance sheet is for short-term leases. So leases of 12 months or less are permitted to be kept off the balance sheet. Next slide, please. So the change for lessees has significantly, the accounting has significantly changed for lessees, but the changes for lessors are relatively, there's not a whole lot of changes. The accounting remains relatively unchanged. For lessors, so lessors will continue to determine whether a lease is a finance lease or an operating lease, and finance leases will be further classified as either a sales type lease or direct financing lease. For operating leases, lessors will continue to recognize the underlying asset, and for finance leases, the lessor will recognize the lease receivable. So those concepts haven't changed under the new standard. The new standard, however, does slightly change the classification of whether a finance lease is a sales type lease or a direct finance lease. So we may see more sales type leases as a result of the new standard. But again, for the most part, little change for the lessor under 842. In terms of effective dates, so the new standard is in effect now for public companies. For private companies and private nonprofits, the new standard was scheduled to take effect for fiscal years beginning after December 15th, 2020, which would be now fiscal 2021 for folks with a 12/31 year end. But because of the pandemic, the FASB delayed the effective date one more year. So the effective date for private companies and nonprofits is now fiscal years beginning after December 15th, 2021. So if you have a 12/31 year end, that would be fiscal 2022. It would start on January 1st, 2022. And if you're a nonprofit or other organization with a 6/30 year end, that effectively would be fiscal 2023. So it will start July 1st of 2022. Early adoption is permitted for all entities, and we do have a number of folks that have early adopted 842. One thing I'll also mention is that this deferral, this 1 year deferral, really is meant to give companies additional time to understand 842 and come up with a transition plan for implementing 842. It's not meant for you to kick the can down the road another year, which I get the sense some folks are treating it that way. So we strongly recommend, if you haven't adopted 842 yet, then to start those implementation plans now. We've been asked whether or not the FASB will delay it one more year. Haven't heard anything yet. Have you, Tom?
No, I was about to say that, it seems like a lot of people are asking the question if it's going to get delayed again. I would say it seems highly unlikely at this point that they would push it down. It seems like most people have got their arms wrapped around the whole work from home, keep the lights on, keep business running. So I'm not expecting anything on my end, and I haven't heard any rumors that it may be in the offing either.
Yep, same here. So our plan is if this is going to go live January 1st, 2022, if you have a 12/31 year end. Okay, next slide. All right, so here we're just going to take a look at a roadmap of how to account for an operating lease under 842 or any lease under 842 from the perspective of a lessee. So after you reviewed your contract and you've determined that you do in fact have a lease in place, the first thing to look at is the lease term, and that begins at the lease commencement date and goes all the way through the non-cancelable period of the lease. If your lease has options, you also have to factor in those options. So if you have an option to extend the lease or to end the lease, you have to factor those options in if it's reasonably certain that the option will be exercised. So after determining the lease term, you then evaluate your lease payments. And when determining the lease payments, also several factors that you want to consider, primarily whether or not there's lease and non-lease components in those payments. So an example, it's not uncommon for a lease contract to cover a variety of different components. For instance, if you're renting office space, the payments in that contract can cover the use of the office space or the office suite, right? That's the identified asset. But those payments can cover things such as security services, janitorial services, security services, landscaping services. These would be the non-lease components. So if there's different components in the contract, then your payments need to be allocated to the lease and non-lease components based on their standalone values. Unless, however, you elect to use the practical expedient and you bundle the lease and non-lease components together and treat the entire lease payments as being part of your lease contract. Just be aware that if you do that, then it's going to result in a higher lease liability. So for folks that are sensitive to the amount of liabilities you have on your balance sheet, you may not want to elect that option. You may want to bifurcate out the lease and non-lease components. All right,
Grant,
so after determining,
I was going
yep,
to say,
go ahead.
Grant, let me add two things there, right? One, on the allocation for people that have adopted 606 already with like their SSP allocation that they have to do, you can think of it in a similar way, right, between the lease and non-lease components. And the other thing relate to the janitorial and the security services that we often see those labeled as in a lease agreement, at least from what I've seen. That would be what you might consider or see described as controllable CAM, right? If you see controllable CAM, effectively you could go and shop for those services from any third party. That would be kind of where you're getting a true service from someone for that money, and not something like reimbursement for real estate taxes or insurance that you're just paying the landlord back for your share of those expenses. So that's kind of the delineation between whether you would include them as non-lease components is are you getting a service, almost like a performance obligation for that, or is it more just a reimbursement of costs?
Yep, thanks for sharing that. We can see how it can be a very cumbersome task for retailers that have a large real estate portfolio. So that option is available to ease the transition. Okay, so once you've determined the lease payments, the next step is to calculate the discount rate. And the discount rate can be one of three rates. You can either use the rate that's implicit in the lease, and that can be challenging to calculate. Second option is your incremental borrowing rate, and that's also proving to be a lot more challenging than folks had anticipated. And the third rate is your risk-free discount rate, and that's only available for non-public companies. Also be aware that if you use your risk-free discount rate, that may result in a higher lease liability. So it may not be a good option for folks that are sensitive to the amount of liabilities on their balance sheet. So once you've determined the lease term, the lease payments, and the discount rate, your next step is to classify the lease. Do we have an operating lease or do we have a finance lease? And that classification criteria is mainly the same under the new standard as it is under the old standard. Just a few slight changes though, but really not that big of a deal now if you have an operating lease or a finance lease, right? That's always been a big deal under the old standard. You get a lease, the first thing you do is go through the 4 steps. Do we have a capital lease or an operating lease? And that always was significant because, of course, only capital leases made it onto the balance sheet. Now, effectively, all leases end up on your balance sheet. So whether you have an operating lease or a finance lease, not that significant of a determination anymore under the new lease standard. So after you classify the lease, you then go through the calculations and you set up the day 1 accounting to put the lease on the balance sheet, and that's followed by the day 2 accounting, which is subsequently measuring the lease and taking it through the end of the lease term. Just as a bit of advice, I think one of the best ways to really understand 842 and understand the accounting, just walk through an example. Walk through a case study, take a sample lease, walk it through from day 1 and how it would look like through the rest of the lease. That way you can really see the debits and the credits and how it impacts your balance sheet and income statement. That's how I teach it, and we teach it here at Armanino for our auditors and our consultants. So a lot of examples out there, and happy to share examples with anyone should you all want to see these examples. Next slide, please. So here we just take a quick look at a summary of the lessee accounting. So you can see finance one day 1, a lease liability, which is measured based on the net present value of future lease payments, and a right of use asset is based on the lease liability, then adjusted for initial direct costs, prepayments, and less any receipts of lease incentives. On the income statement, if you have an operating lease, you recognize a single lease cost on a straight line basis over the lease term. If you have a finance lease, a portion of the payments are recognized as amortization expense and a portion as interest expense. On the cash flow statement, all cash payments for an operating lease are presented as an operating activity, and for a finance lease, a portion of the payments are presented as a financing and a portion presented as operating. Next slide, please. For lessor accounting, we can see that there isn't a significant change from the legacy lease standard. For operating leases, the lessor will continue to recognize the underlying asset on the balance sheet. And for a finance lease, you continue to replace that asset with the lease receivable. These concepts, again, haven't changed under the new standard. Under the on the income statement, lease income is recognized on a straight line basis for operating leases, and for a finance lease, you recognize interest income and any gain or loss from the sale. On the cash flow statement, if you have an operating lease, those lease receipts are presented as operating, and for a finance lease, on the cash flow statement, you would present the principal portion as financing, and then the interest portion that you receive as operating. So all of that's relatively unchanged from current GAAP. Next slide, please. Also want to mention that the definition of a lease has changed under the new standard. Okay, so under the new standard, a lease is a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So there's two main points of emphasis here. One is having an identified asset, and two is the right to control that asset. And identified asset can be either implicitly or explicitly stated in the lease, and it could be asset, such as equipment, real estate, aircraft, you name it. But you need to have an identified asset. And then the right to control means the customer has two things. Okay, you have the ability to obtain substantially all economic benefits from the use of that asset, and you also need to have decision-making authority over the use of that asset. So this definition of a lease under 842 is a bit different than the definition of a lease under 840. And this whole concept of the definition of a lease, it's a lot more complex than I'm giving it credit for, just based on this one slide. And we can do a whole 1 hour session or more just on the definition of a lease and the various factors that come into play when you're evaluating whether or not a contract is a lease or contains a lease. But the key takeaway here is that this definition of a lease has changed under the new standard, and now determining whether or not a contract is considered a lease is a much more important determination under this new standard, because it's really going to mean whether or not you account for that contract under 842. So as I mentioned earlier, under the old standard, the big classification issue has always been, are we dealing with an operating lease or a finance lease? Under 842, the big determination now is, do we even have a lease? Does this contract even a lease, or does it even include embedded leases? That's another concept that's at a lot of confusion, where we have these contracts that we never thought of as being a lease, but now there may be a lease embedded within that contract that we need to pull out and account for under 842.
Grant, and one example, right, just for the audience of an embedded lease that may be helpful, just to provide a little context, would be, say I have a printing agreement with a company that historically would just be a service agreement, right? And they are doing something very special for whatever my company does. Maybe it's printing on very special paper or very special specifications for the machinery that I have or whatever. If that printer can really only be used to satisfy my agreement with you, the printing company, that would theoretically, under the new standard of what meets the definition of a lease, that would meet that definition, and you immediately end up with a lease on your books for the use of that printer, because it's set aside, it's identifiable, it's only used really to service your agreement. And so I know from conversations I've had, embedded leases can get a little abstract and people get slightly spun up and confused as to what that might be. To me, that's one kind of agreement that people can put their arms around, right? People can understand, okay, that makes sense. It's a single piece of machinery that they are using to support the agreement they have with me. So it's effectively me controlling the asset by them doing it on my behalf. So just wanted to interject that there.
Now, that's a good example. Another example that we dealt with maybe about 1.5 years, almost 2 years ago, was one of our hospital clients. They had a service contract with an anesthesiologist company, and that contract included a whole lot of different services. And part of that service contract meant they're going to keep their equipment on the hospital site, and the hospital had the ability to use that equipment, control that equipment. Under the old standard, we never thought of that contract, that service contract, as a lease. But now that equipment, the use of that equipment, it's embedded within that service contract. So we had to pull that out and determine what payments from that service contract are allocated to that piece of equipment and then put it on the balance sheet as a lease liability. So you can see how it can be quite complex.
All right. Thank you, Grant, for that information. It is now time for our first polling question. So where are you at in regard to adopting ASC 842?
And as you were just describing that last example, it just made me think about contracts where, 606 sort of crosses over into 842 as well. We've had a couple of clients where, the contracts really are playing two different roles there that you have to consider when you're adopting both standards.
Yeah, a lot of similar concepts with 606 and 842. I think for that reason, a lot of folks elected to early adopt and implement 606 and 842 at the same time.
All right, so 58% have performed preliminary research and 22% have not started at all.
And 16% are fully implemented. That's kind of cool to see that there are some people out there who have fully implemented. I guess that leads me to my next question to Grant. For those who have adopted, and you and the rest of the audit team are out there performing the audit work now, what are you hearing regarding that new lease standard and how it's impacting the audits?
Yeah, I mean, I think what I've heard and what my colleagues have heard is we've heard a lot of different feedback from companies regarding the transition to 842, and I think it's been a mixed bag of both horror stories and some success stories as well. And that feedback is reflective of how well prepared or ill prepared the company was in transitioning to 842. We work with companies that have already adopted and they planned very well and they prepared very well for that transition. They engaged the auditor, they engaged the consultants early on in the process, and they had an implementation plan well before the start of the audit. And the general feedback and consensus from these folks was that there was a reasonable amount of additional time and effort that was required, and the challenge that they encountered were reasonable and similar to the types of issues that they would expect to face when implementing any sort of big accounting standard such as 842. On the other hand, we've worked with many companies that weren't as well prepared and they waited until the last minute to implement, and the general feedback from these folks was that it was very painful, very challenging, led to delays in the audit, increased cost. This is even more true for companies that have a lot of leases in their lease portfolio. And we're also talking to a number of private companies and nonprofits that haven't implemented the new standard yet. And I think as the poll results show, a lot of folks are in that stage where they haven't done anything at all, or they just barely started that preliminary research phase. And that's a bit worrisome just because we've seen and the lessons we've learned from some of the companies that have implemented is that you want to start early. So for folks that really haven't started the process yet, again, we highly recommend that you start that process now, start reaching out to your auditors and consultants and come up with a plan for implementation. Definitely not something you want to do start last minute as you're preparing for the audit.
And Grant, has there been a correlation from what you guys in the audit department have seen between how well people have accounted for 840 historically and how easy that transition has been to 842?
Yeah, I mean, obviously, folks that have a strong grasp of lease accounting, folks that have a lot of leases in their portfolio where leases are an integral part of their business, we've seen in general that these folks have transitioned better to 842. But lease accounting is kind of unique in and of itself, and there's a lot of unique accounting factors in there. And folks that don't have a lot of leases, this could be sort of a new concept to them, where it's been a bit more challenging.
Hey,
so definitely.
Go ahead,
Teresa.
No, sorry. Go finish your thought, please.
No, I'll say we saw the poll results. I think it was like almost 70% are either haven't started yet or started preliminary research. So again, the takeaway for the advice for you all is start now. Start now because it's going to be taking effect pretty soon.
Yep. Hey, Tom, you and I have been working a lot with SPACs and, you know, potential IPOs as well. And it's a big leap for some of these companies to go from a private set of books to, you know, becoming ready to be a public company. And as they're considering doing that SPAC and they're not 842 compliant yet, is it possible to get compliant fast enough? Because SPACs are really looking to turn around a transaction within 3 to 6 months. It's much, much faster than your traditional IPO where you've got 18 months of runway. So is it even possible to get there that quickly?
So I'm gonna hedge a little bit, and I'll say most likely, but it depends, right? This lease standard obviously impacts certain industries more, and where they're more asset intensive and maybe more lease intensive. We've talked about retail. In my mind, that includes things like supermarkets and other sort of multi-location, many location and equipment dependent industries. So healthcare, things like that, in industrial type areas, still probably have time, right? Because they are most likely on top of things when it comes to their ongoing lease portfolio. Historically, they've had to be a little more on top of it. The other thing I'll say, and you know, we're advising clients that are going through SPAC transactions right now on this, is we would very much recommend people get it done pre-transaction, even if you are an emerging growth company. And clearly I'm not SEC counsel here, so if you are going through a SPAC, go ahead and talk and make sure you are or you're not. But if you are what they call EGC company, which is typically revenues less than 1.07 billion a year, you have some wiggle room, right? You get to go in with the private company adoption date. The thing that we're cautioning people on, just from knowing what we know from our side of the table, is you are going to have enough going on that's on your plate as you transition from a private to a public company, as you go through this de-SPAC process or newly, you know, freshly minted public company process, that you don't want to have to try and get a lease standard adopted while you're going through, okay, we've got to file our first K, our first Q, we've got to figure out, you know, all of this new world that we're now dealing with. You know, I would say there's a reasonable amount of difference between being a well-run private company and being a well-run, able to close the books and get everything out the door on time with guidance and make sure everyone's on the same page as a public company. And so the last thing that you want to do is to be trying to muddle your way through a leasing standard, similar with, you know, for people that have managed to put off 606 to this point, right? It's the same thing. We recommend you get 606, 842, you get those things done behind you. You don't have to worry anymore. The only other thing I'll add from my conversations with some of the software vendors for lease platforms is I think they are getting a little bit nervous with knowing how long people are punting this down the road. You know, we've got 70% of the audience that are still gently dipping their toe in this lease pool. I know there's a little bit of discomfort from their side, knowing that there's going to be a rush for the door at some point when people quickly try and get this adopted, and everyone's going to want their software platform if they're using one set up yesterday like that. And you know, there's only so many bodies and so many people that can get that done. And so I would echo Teresa, echo Grant, even if you're not planning on doing a SPAC this year, a lot of people we're talking to didn't envision a SPAC at the turn of the year, and they're already got LOI signed and they are firmly down that path. I would say start doing it now. The longer that you have, the smoother and the more strategic you can be with some of these decisions that you're making. It's less of a scramble, less likely to have potential, you know, weaknesses if you do need it. So yeah, just greatly encourage people to get going. It always takes longer than people think it's going to take. You know, you had the early adopters like Microsoft and Apple complain to the FASB that this was much more of a a lift than they had anticipated it being back in 2017, 2018 when they were going through this. And so if it's a struggle for companies with resources like Microsoft and Apple, it's going to be a lift for anyone, right, on a relative scale.
You do a lot of work, Tom, with SPACs and helping companies get up to speed on these accounting standards. What's some of the way that you can help companies, or how can a company best engage you and your team to help with this new lease standard?
Yeah, so what we tried to do, right, and that's a good question, Grant, because it's definitely not a one size fits all for everyone. It depends on the company, it depends on the industry, it depends on how they want to approach things. We've seen it full scale, right? Either they just want us to kind of support and be technical advisors and helping them know the pitfalls and get through some of the practical expedients and what should they be thinking about in terms of software platform, things of that nature, to where we have other companies that basically say, we don't have the bandwidth, we just need you to take this off of our plate and coach us on the back end through workshops and trainings and get us up to speed on an operational basis. So we've kind of gone from a hybrid type implementation approach for people, or even just a scoping exercise to tell them what we think the roadmap is realistically going to look like for them and the manpower it's going to take, to they just toss it over the wall at us and they say, please do this, and let's have regular scheduled meetings so that we can stay apprised of progress and whatnot. But basically we don't have the time or the capability, so take it off of our hands.
Yeah, we as auditors. Go ahead, Teresa.
Tom, that's a great point. I mean, even if you just perform a scoping exercise to find out if it's bigger than a bread box, we used to say, that at least tells you what you need to plan for. I think that's actually a good move. And there's a couple of questions out there, Grant. I don't know if you want to try to address any of these, but there's some really good ones coming in.
Monitoring the questions, so let me,
yeah, so
let me take a look. I've been intently listening to Tom's advice, so let me take a look at some of these.
So I've got one from John that talks about things like WeWork, right, and these flex space arrangements. I'll say that there are two different flavors of these flex space arrangements. There are some now where you can get a specified office within their facilities that is effectively, the same as any other office agreement that you would have. It's designated to you all the time. You can put your logo on the wall and things like that. That would meet this definition of a lease because it's identifiable. It's typically labeled as a separate suite within the building and whatnot. If it's more of a come and go as you please and you have common area access and true, what I think in my mind when I think of WeWork, when it's come and go, that we've made the argument historically that is not a lease and you would keep that out of your lease portfolio, and that is truly just an agreement that you have, like a service agreement that you have, and there is no designated space that you would use within the building except for you have full right to any of the common space, right? It's not identifiable within the agreement, more that you have two people that can go to that location 3 days a week or whatever. And David, I see you were asking about the de minimis threshold. So unfortunately, I'm going to say that there's not one, which gets, to be quite frank, quite annoying when you're dealing with, ice machine leases and things like that might be $10 or $20 a month. Okay, realistically, someone like Grant is going to be reasonable, and they're not going to give you a hard time over that. But realistically, to the nature of it, there's no de minimis or immaterial lease out or practical level.
There's no small dollar exception for 842, right. But as Tom mentioned, me as an auditor, and I think most auditors would audit within materiality. If it's clearly immaterial, we're probably not going to lose sleep if you don't put it on your balance sheet.
But if you have thousands of those ice makers across your chain of restaurants, that might be a little bit different.
And that would be a different story, right?
Okay. I think, Nyla, you're probably going to tell me we need a polling question here so that we get everybody their CPE. So I'm going to stop talking and let you jump in.
All right. Let's see if you guys are paying attention to what Grant was saying earlier. When is the effective date of ASC 842 for private companies and nonprofits? Well, it seems that most of you guys are paying attention, and the correct answer is indeed B. The fiscal year is beginning after December 15, 2021.
That is a correct answer. Thanks, Nyla.
That is the right one. Thanks, Nyla. Okay, I'm going to jump. We'll come back to some of the questions that have been coming in. And by the way, for anybody that we don't address your question on this call, we've committed to getting answers out to everybody following the call, as well as the materials that we covered. So thanks for being patient with us. I do have some questions for the team. One, I wanted to really get out there, Grant and Tom chime in as well, but we've talked about the leasing standard. You know, we as accountants and finance people take on the brunt of all the work to get this all implemented, but there's got to be impacts outside of accounting and finance. Like there's other people and other teams and stakeholders that are impacted by it. And can you talk a little bit about that?
Yeah, appreciate the question. Good question. You know, for any sort of significant accounting change, we always recommend that you think about the stakeholders outside the company may be impacted. And this is especially true for 842 because it impacts so many parts of a business. So I would start with your bankers. Obviously, you know, because of 842, your liabilities may significantly increase. So think about how that impacts your banker's perception of your key metrics and your ratios and how leveraged you are. Your debt covenants may be impacted. So start discussing the impact to your covenants with your bankers. You know, you shouldn't face a covenant violation because you've adopted 842 or implemented an accounting change. That wasn't the intent of 842, and then the FASB even came out and said liabilities arising from operating leases aren't meant to be classified as debt. So hopefully folks aren't facing a covenant violation, having their debt called all of a sudden because they implemented 842, but that can't be assumed. So start those discussions with your bankers. What some folks have done is incorporated clauses into their debt agreements where their covenants are being calculated based on the lease standards that were in place at the time they entered into the debt agreement. That's what's referred to as frozen gap. But just that may require maintaining two sets of books, so may not be worth it. But obviously start engaging your bankers on how 842 will impact your balance sheet. I would say your investors would be another party you want to start engaging. There could be significant changes to your balance sheet. You'll see more assets, you'll see more liabilities, your EBITDA may be impacted. You may see an impact to a variety of other financial metrics, ratios, and KPIs. So start preparing your investors for these changes. Who else am I missing? Tenant advisors, just your corporate real estate team. You know, think about how this new standard could impact your corporate real estate strategy. One of the benefits of leasing was that it enabled you to have the right to use an asset, but keep those liabilities off the books, right? That benefit isn't there anymore for an operating lease because now it ends up all on your balance sheet. So will that impact your buy versus lease decision? Maybe. Obviously, having a longer lease term would result in higher liability. So will that impact the length of the leases you're entering into potentially? So definitely engage your corporate real estate teams. Legal counsel, obviously, they're always going to be an important part of any transaction. And just now, because the definition of a lease has changed so much, you may want to start involving counsel as you enter into contracts and constructing agreements, because you may be able to construct it in a way where it gets you out of 842. So definitely engage legal counsel. Who else am I missing, Tom? I feel like I've hit.
I would say, you know, anyone within the company on a operational basis, right, that may be executing agreements or having some sort of ownership, maybe divisional folks or product managers that can go out and sign new agreements. You've got IT, you've obviously got your normal kind of real estate facilities people, even M&A folks, right, are going to need to know some of this for their diligence effort. It really is accounting leading the compliance charge, but it does give the capability for folks to come together. And I know how accountants, the classic stereotype is they won't stop talking, and the party people, right? Big time extroverts. So it really gives you the opportunity to get in the conference room with people from outside of just accounting function and make sure that everyone's on the same page. I mean, that's going to be a key change from this, because historically wasn't a big deal with footnote disclosure, materiality. Typically you had some serious wiggle room in terms of, oh, a lease got missed on a contingency footnote. Now you're looking at face of the financials. It's going to be a much harder climb to get the auditors past that once you get down that path.
Yep, for sure.
Thanks. I'm going to skip ahead to a couple of other burning questions. One for Tom, talking about day two accounting. So, okay, so I go ahead and adopt 842. Now I'm done, right? Is that like I'm done and I don't have to think about it much anymore? Or because you mentioned it is a pretty big uplift. What does it mean for the skill set of the people in my accounting department and others for maintaining that going forward?
Yeah, the sad reality is 840 was kind of a set and forget type standard, right? You signed a new lease, you worried about it, and unless there was an inflection point with that lease, maybe a modification or a termination of that lease, no one really messed with it. They left it in the deferred rent schedule. Oftentimes deferred rent schedules are wrong, or don't get properly updated for changes. And yeah, so they kind of got left on the back burner and only came out when the auditors came knocking at year end. With 842, there's this requirement for you basically to have this ongoing monitoring of your lease portfolio and determining if any of the assumptions that you made when you signed the lease and got it into either your Excel model or preferably your software platform, whether any of those assumptions need to be updated or changed. Things like Grant mentioned earlier in his kind of classroom time, right? The term, the renewal options that you've decided and management feel really good about the fact that you're going to be renewing that extra 5 years. All of a sudden, you need to remeasure that lease over that new 5-year term. You have more lease liability coming onto your books. The other thing is, we talked about discount rate or the incremental borrowing rate. That's likely to change over time, and it's supposed to reflect the time that you sign this new lease that you've got. And so you have to keep up with that and make sure it's current with what you're doing in your current calculations. There's a lot more footnote disclosure requirements with this new standard that is going to, clearly the auditors are going to have a lot more eyes on this from base of the financials to all the way through. And so that's why we talk about the ongoing communication between functional departments to make sure that information is flowing the way that it needs to back to accounting. It really does need to be on a more real-time basis now, and not just a once a year hurry up and clean up an Excel schedule before Grant comes in and looks over your shoulder and makes sure that everything looks squeaky clean.
So that rolls right into my next question then, which is for Grant. So Tom, you mentioned changes in leases and timely COVID, right? We're seeing a lot of lessors give rent concessions, right? So I guess a two-part question. Number one, how are people accounting for that? And number two, Grant, given everything we've been talking about, what new testing procedures are you rolling out, and how much scrutiny is going to be placed on it when we perform the audit work at your end?
Yeah, great questions. Let me tackle the first question. It's a very timely and relevant question, and that's the topic of rent concessions. We've seen a lot, as you mentioned, landlords grant these rent concessions to tenants during 2020. Rent concessions can come in a lot of forms. Probably the two most common is reduced rent or just deferral of rent payments. So under the standard, in most cases, when a rent concession is granted, you have to go through this process and evaluate whether it's considered a lease modification. Okay, and the accounting rules are a bit tricky because, again, you have to go through the lease and evaluate your lease to determine if a modification has occurred, and if it has, then you may need to change the entire accounting of that lease. This can be super challenging for folks that have a lot of leases in their portfolio. And I think when the FASB wrote the rules, they didn't intend for widespread rent concessions to be granted, such as what happened in 2020. And the FASB realized this, and they realized companies have a lot more important things to focus on than reevaluating the accounting for their existing leases. So in I think it was April of 2020 or so, that the FASB came out and said that if you receive the rent concession and that rent concession is related to COVID-19, then you can elect to account for that concession in the current period, just based on the terms of the concession. So basically, you're not having to go through and evaluate whether or not a modification has occurred. So that eliminates that step for you. It'll make the accounting a whole lot easier. Just basically just capturing that difference in the current period. There could be some disclosures as well that's going to be required. We've had a number of clients that have elected that option to not treat the concession as a modification. So there's some standard disclosure language that we're recommending you put in your financial statements.
Thank you.
Anything else am I missing there on the lease mod?
I think that was pretty good.
I think that's, yep, I would agree with that.
Forgot your second question, Teresa. Was it about our audit approach?
It was just the audit approach. What kind of new testing procedures are you going to be rolling out? And then I think we need to jump for a polling question for Nyla, so I'll let you answer that one.
All right. So I think just from me as an auditor, we'll be placing a lot more focus on your leases, right? Under 840, the old standard, if you didn't have a lot of changes to your lease accounting, we're probably going to spend a whole lot more time on it. We probably would have just obtained the lease schedule, tested the lease expense, tested deferred rent, and tested that the operating lease disclosure was accurate. But under the new standard, we'll be looking at leases with much greater detail. Obviously, we'll be obtaining your calculations of the lease liability and the right of use asset, calculating those schedules to determine the accuracy of the day one accounting. We talk about a lot of elements that go into that calculation, like the lease term, the lease payments, the discount rates. We'll be auditing all of that as part of the audit. Tom mentioned disclosures. That's another area that I think is often overlooked. There's a ton of new disclosures that's required under 842, and I've done a lot of QC reviews of financial statements where they don't include these required disclosures, and it becomes a fire drill at the end trying to pull together these disclosures. That's another area that we will be looking at closer. It's just the disclosures surrounding 842. So I would just expect companies out there to just know that your auditors will be making lease accounting a much greater risk area. It's a different focus of the audit.
Great, thanks. And I'm going to let Nyla do the next polling question.
All right. How many leases are in your company's portfolio currently?
And while people are answering this question, I wanted to say again, we're getting a lot of great questions coming in. We want to respect everybody's time and make sure that you get your credit. So we've got time for a couple more questions, and then we promise that we will follow up with the ones that we can't answer via sending a note out to all the attendees and or set up a call with you to chat a little bit more about it if you'd like.
All right, so 47% answered less than 10, 39% answered 11 to 100, and 14% answered 101 to 1,000.
Okay, so it looks like a lot of folks have a minimal amount of leases in their portfolio, being less than 10, so there's different options that you can go about transitioning 842. Obviously, the transition is a lot easier if you have a nominal number of leases, but for folks in that, I think it was a 11 to 100 bucket, for you all, we strongly recommend starting that process now, because it's the mere task of aggregating all your leases into a central repository and then extracting data from those leases to perform the day one calculations can be a very daunting task.
Yeah, and I'll just tack onto that really quickly, because as I mentioned earlier, right, 840 was kind of set and forget. You didn't have to maintain a lot of data about some of these leases, and the underlying specifics and terms. With 842, it's having a lot more variables in play and things that can impact the treatment and the length that you're recognizing and bleeding things out over. The sooner you can get going with that, the better.
So to that end, Grant, just a point that you made, I mean, if I've got less than 10 leases, I may, be tracking that in Excel, but your team is going to go and audit the calculations in the spreadsheet and whatnot. If you've got like the 38% and the 14% of the population here that have between 11 and 1,000 leases, that's going to be a hard lift if you keep it in Excel. I just wanted to point that out. And I think Tom mentioned earlier today during the call that some people are opting to implement software. This is not a sales pitch for software, but as it relates to your evaluation of what you should be doing, that's something you should consider.
Yeah, for sure. I think if you have, less than 10 leases, Excel can probably work. That's not too big of a lease portfolio to handle outside of Excel. But once you get, 25, 50, 100 leases, that's where you really need to contemplate using a more robust lease accounting software, outsourcing it to someone to take care for you. If you continue to use Excel, and we do have clients that have 50 leases and they're using Excel, just know that we as your auditor likely going to spend a lot more time auditing your lease accounting. Just inherently some limitations and risk factors with using Excel. One accidental keystroke could ruin the whole workbook. Data integrity could be a big risk factor. So just naturally using Excel gives rise to more human error.
It's easy for me to say, right, as an outside party, but realistically, for some of the costs that these software vendors are asking for, the efficiency and that, additional audit work that Grant has to come in and do over spreadsheet controls and making sure the mechanics of every worksheet is the same. I think a lot of people have been surprised at what the cost might be if you don't have a huge lease portfolio and what the value add could be in terms of what that the FTE could do with the remaining time that they're not kind of fiddling around with spreadsheets.
That takes me to my next question, Tom. I'm going to skip to something about people and skill sets. So let's say I have consultants come in and sort of clean up and inventory all the leases and get me all implemented and up on 842. What sort of skill set do I need to have in my accounting department going forward to manage it? And second part of the question, what kind of training can they go get if they don't have the skills?
Yeah, so it's interesting, right? Because a lot of it is going to be probably the skill set that everyone wants to have in their accounting department anyway. They want detail-oriented folks that have kind of got their head on a swivel a little bit and can see some of the changes and think through some of that incremental difference about like, okay, this is how it used to be, this is what it is now, what do I need to do to bridge the gap? In terms of communication, I think communication is going to be more important and kind of that proactive communication instead of reactive communication, dealing with procurement and legal and finance to make sure that everyone's on the same page, information's flowing within the organization as it needs to, and it's getting updated in the system on a truly timely basis. And in terms of training, I saw a question on here about Big Four firms have guidance on 842. Looks like Grant just answered it, and we have white papers. We put out blog posts about 842 and what can help. Obviously, in a blog post that we put up, it's more tidbits, right, and kind of practical tips and maybe things that we see in the market that can benefit folks. Much like Big Four, we have a white paper or two about 842 and adopting it, and so there are resources at this point with the public companies having gone through this adoption already. There are resources online that people can get brushed up on. They can obviously, we are very hesitant to do 842 projects from the consulting side, where there isn't an element of kind of workshopping and training to give the operational folks that working level knowledge, because at the end of the day, they need to be able to know how to maintain this on an ongoing basis. It doesn't really matter to to you, the client, that I know it. You need to be comfortable that you and your team know it and can stand on your own 2 feet once we walk out the door, virtually or otherwise these days. So yeah, I think there's a lot out there on the internet that can kind of get you semi-comfortable with some of the concepts. Obviously, contracts can be fickle in that they can be very specific, and there can be key terms in there that will really turn the treatment of things. You know, folks like myself, Teresa, Grant, we're always available for questions or just as a sounding board to help you out as you maybe tackle some of the company-specific problems that you're facing.
Great, thank you.
Can we do our last polling question, Teresa?
Yeah, I think,
right?
yeah, I think we have one last polling question, and while that's coming up, I'll ask each of you to give me your top 3 takeaways as we have 5 minutes left. But Nyla, you want to?
Yeah, sure. So the last question is, what type of solution or technology are you planning to utilize for the adoption of 842?
So I guess folks, go ahead, Grant. You're good. Go for it, buddy.
No, go ahead.
In the vein of technology, I think my recommendation would be that your life can be made a lot easier through a lease-specific platform. And so even if you ultimately decide on not using one, I think it's beneficial to do a couple of demos with some of the providers and look and see, you know, if it is a cost benefit that makes sense for you. We, as part of our engagements, will always provide a manual model to test, you know, 2 or 3 of the calculations that are coming out of the software, because management typically want that comfort level to know that they can understand in Excel what's going on behind the nice kind of polished skin of the platform. And so I would just say, you know, take a look, see what you think it can do for you. I'm happy to share my thoughts on any software system that you may be looking at, but that's one thing that I think can really help folks as they go ahead with this.
Great. And so the results, 27% are considering lease accounting software, 65% will use Excel, 3% outsource. We didn't talk about that as an option, but certainly a good option to just sort of get that off your plate as well. And then we have 5% other, not really sure where those folks are doing it, maybe in their ERP system. And there are ERP systems that handle the lease accounting as well. Okay, last few minutes then, I would appreciate each of your top 3 takeaways, and then we'll get all the information out to the folks who attended.
Sure, I could just go through mine real quick. I would say just start the process now. It looks like a lot of folks on the call have less than 10 leases, so you certainly still have time for the folks that have a larger portfolio of leases. Start the process now. Don't underestimate the amount of time and challenges that this implementation will take. Make this an entity-wide project. Involve members of your accounting team, finance team, legal, sales team, real estate team, IT. So make this really an entity-wide project. And I guess don't go about this alone. A lot of folks out there to help you, like folks like myself and Tom and other consultants and CPAs that you can use as a sounding board to do this.
I'll piggyback off of one of Grant's there, which, you know, is start now, start while you can, and you've probably heard us say a few times here today, right? It takes longer than expected, and part of that is the difference between this and RevRec. Most of you, I'm sure, are already aware, but no one is really undercutting their RevRec, right? Most people are pretty on top of all of their revenue streams and have completeness documented about revenue. The difference between the leases is you have to go through the process of saying, here's why this lease portfolio that I'm putting in front of you, Mr. Auditor, is complete, is accurate, how we've gotten everything, how we know our service agreements don't have embedded leases. So there's just documentation and some rigor that goes with that. And obviously, it depends on the number of locations, the transactional volume that your company has, depends on how easy it is to be able to show why, you know, this recurring payment is or isn't a lease, and walk through those steps of ruling it out through a little kind of tree diagram and make sure that it comes out as not a lease. The other thing, you know, there was a couple of questions on incremental borrowing rate. Sometimes you've got to go to the bank and get a representative reference rate. So if you start early, you've got more time to get that done. I know I'm out of time, but as Teresa said, we will we'll look to get the questions answered and over to you as soon as possible, along with the slides. I'll hand it back over to you, Teresa.
Yeah, really appreciate everybody joining today to listen to the experts, and hope you've learned something along the way. And I will let Nyla close us down.
Great, thank you guys so much. Again, we will be sending out an email with a link to the recording and the slide deck within 48 hours. Also in this slide deck, there's a couple resources for you guys, some FAQs and some other links that would be helpful. And again, any questions, feel free to send them to the panelists' way. Thank you again and have a great day.
Thanks, everyone.